All right. Good morning, everybody. So it looks like the banks are already starting to miss. JP Morgan missed their estimates. Want to take a look at what happened in the overnight hours. There's very often a carryover from market sentiment. If Asian technology is doing good or Asian transportation, uh, energy, whatever, it tends to bleed over into our market. So it's a good place to start, just looking around in the overnight hours, kind of asking the question, what happened while I was asleep? Sometimes it's a little bit of a chicken and an egg. What comes first? Um, did we rally the overseas markets, or did they rally our market? So we can see that oil went up a little bit, gold went up a little bit. That's about it on the overseas. Check the world economy, same thing, just kind of glancing around, making sure we're just kind of looking to make sure there's nothing out there that would get our attention. And a lot of times you're not going to see anything, right? You take a look, there's nothing there, you move on. You don't want to invent something and turn it into something that it's not. All right. From that, good place to good time to go over and look at the Thinkorswim, see what's on the calendar for the day. You can see we have the PPI 8:30. We have a lot of events at 10 o'clock, and then we have an additional auction at 1. The the petroleum status report doesn't really impact the market that much, but it does provide a trade opportunity if you were to focus on USO. It's a smaller ETF. It can often be a lot of fun. You're basically going to get the opportunity to trade like you would trade an earnings report, right? Uh, the earnings report comes out, a stock usually jumps up or down for a little while, and then it settles back into place again. Well, every Wednesday, you got the EIA report. It directly affects USO. You could go over to USO and look for an opportunity to trade that, even if it's just a small 20 or 30-minute trade, and you're right back out again. If you want to think about how you could approach that, well, you know that it's every Wednesday, and it's at 10:30 on USO. You could go back and look at previous Wednesdays on USO at 10:30 and look at what happened and start asking questions like, can I make money off this move? Is there any edge in here for me to develop a trade? All right, I know this may look really cluttered and kind of extreme. Um, I don't leave this indicator up all the time. This is an indicator that's asking how far away from the 10 period moving average are we? That 10 period is on the weekly and on the daily. What you'll notice, get to trading for a while, is when the market extends past the 10 period quote too far, it very often pauses there and or reverses and comes back to the 10. Think of the 10 very much like a magnet or the middle, the median. When when you're dealing with the market, linear regression and mean reversion is the norm. It's the standard. Well, where's the edges of a range when you have price making swings to the upside and price making swings to the downside? Where's the middle of those swings? That would be the 10 period. Every market every market changes its behavior when it gets too far away from its 10. We have to know how the particular market we want to trade deals with the 10. So I made this indicator so that we can look back and ask the question, historically, what does it do when it extends past the 10 on a weekly time frame more than 2%? 3%, 4%. Well, we can see that 4% is, 5% is about that reversal spot on the weekly time frame. If we get more than 5% away from the 10 week, we very often pause, consolidate, reverse, come back the other direction. We've just recently crossed back below the 10. So from our current location, if this is the starting point, think about it like a basketball court. You start in the middle and there's a goal on either end. Well, right now we're basically right in the middle. We could go either direction, 4%, 4% away from the 10 period. Ask the same question on a daily. Have we moved too far, too fast? Which is basically what we're trying to ascertain here. The market made a significant move in the last few days. Was it too far? Are we outpacing what is considered an appropriate measured move? When we get too far away from that daily 10 period, we will reverse or pause and go back the other direction. We can see on a year-to-year basis that 2.5 to the upside, and more like a 3.5 to 4 to the downside before we get to that reversal spot. We've got plenty of room to move away from the 10 period before looking for a pause or a consolidation. These indicators are in the Discord that I built that holds all the indicators. Just search for distance from MA. There's a lot of moving average indicators in there. So looking at these two indicators, we have not moved too far, too fast, and there's plenty of room to go. All right, I want to approach this today the same as we do every day. 3 scenarios. We could stay range bound within our own Globex range. Technically, that is possible. I just find it really unlikely. So there is this. It speaks for itself. I find this doubtful. Take that same range, though, and extend it to yesterday's high and yesterday's low. This would still be considered the same concept, that we're in a range. And this is a very large range. There is plenty of room for some really beautiful price action, just like yesterday. But it would still be a range. If you're inside of the previous candle, then you didn't get higher highs and higher lows. You have less than yesterday's high and less than yesterday's low. Right? You're not trending when you're sideways. This would fall under the thesis that we remain range bound today. 43.75 to 44.65. It's entirely possible that we do that. That's a very large range. So that's the first thesis. But what if we happen to make it through all of that and actually begin going somewhere? Well, we're up 0.5%. We've got an ADR of 1.6. So we'll just add a 1% move and look at where we're at. We're not outside of yesterday's range yet. Kind of encourages the idea that this very well could be a range bound day. So let's go ahead and get the entire ADR, and that puts us right at yesterday's high. So if we take every little bit of the ADR, we can get to yesterday's high. The really cool thing is about those blowout days is that we extend well beyond our average, and this is the average right now. So from our current location, we're up 0.5%. Just add 2% to this market. That'd be a 2.5% move in the S&P. And that gets us up to the point of control from the other day. It's 4,500. That would be an extreme bullish signal. So if the economic news comes in, and there is a lot of it, and we get bullish, that would be our bullish upside target, 4,500. To the downside, just getting down to yesterday's low is 0.83. That keeps us inside the ADR. If we take all of the ADR, that's 4360. And if we make that 2% move to the downside, we'll go 2.5. From our current location, we'll just add 2%. That puts us down at 4324. So that's our extreme bearish case. 4,500 to the upside, 4325 to the downside for extremes, right? It would not be subtle. It would not be soft. It would be very much like yesterday where the ticks gave you all the information you needed. We had consistent, persistent, nonstop direction in a single path, right? Take a look at this on the volume profile. We can see that we're outside the boundaries of the volume profile, and there is some volume resistance now over our head, basically around the Globex high. So when we get into the Globex high, we're going to be getting into some serious resistance. It's not going to be just resistance because it's Globex high. It's going to be a volume resistance. We did get a nice V bottom reversal yesterday. And it does match like a micro double bottom, the way that IBD talks about double bottoms. It's interesting that IBD suggests double bottoms should go lower than the previous low. Right? I used to get that wrong. I used to think that it was supposed to stop right at the previous low. And no, it's supposed to go deeper. It traps short traders so that when it begins the rally back up, those short traders are buying to get out of their short trade. It's squeezing shorts, and it makes the move to the upside even more violent than it normally would be. It's pretty awesome. Tricky bastards. Looking at the volume profile on a 5-day, 5-minute chart, it's what we call the 5x5. There's no point of control that we need to worry about. You can see we're back above the weekly expected move where we need to hold it. If we did make that move to 4,500, that would be the point of control that we would need to be concerned about. Right now, we're at the COG line of 4411. So that's our downside, upside in the ES. It's going to be very, very similar on the Nasdaq today. Same concept, same logic. We are inside of yesterday's price action, and we very likely could just stay right there. From 14,300 to 13,900, there is plenty of room to just stay there. That would be making a case, making an argument for a range-bound day. If the news happens to be really good, we could see a move to the upside. We're only up 0.5%. If we were to game that out and add 2%, that would get us literally right at the top of yesterday. So let's go ahead and price in an additional 1% move. That'd be 1% beyond our current ADR, 14,450. That would be the bullish and extreme bullish upside move. Do the same thing to the downside, and extreme downside would be 13,591. I just aim for the roundy 13,6. Now, we don't want to arbitrarily draw these lines, right? We want to be able to take it over, look at the volume profile, and ask, is there anything here that can validate this perspective or analysis? We do have a lot of resistance at 14,100. You can see we hit that in the overnight hours, and we struggled to get through it. We are outside the box. When we're outside the box, we got to ask that question. Are we moving towards the box, or are we moving farther away from the box? Well, we were moving towards it. We couldn't get through the volume. We've rejected and we're pulling back. We are back inside of the expected move, just slightly, but we are back inside of it. Again, mapping it out on a 5x5, taking a look here. There's not a lot around on either side. I know no virgin points of control unless you were to see that 14,400 move. then there's a point of control up there that has not been hit yet. The hedge trade is still on. You can see gold continuing to bid up. The bonds made an exaggerated move yesterday, tried to mean revert, and is making another run for it. It's really interesting to see the algos in there playing. Even last night in the bonds, or in the S&P and in the Nasdaq, it looked like the VIX was finally starting to wake up, and then it just calmed right back down again. But the dollar was really responsive to our moves yesterday. Consider the dollar right now as a more responsive VIX indicator. It's a really great gauge right now, because it really seems like our VIX is decoupled with the risk that's going on in the market. It's like investors have gotten to the point where they're numb to the risks that are out there and they're just not hedging, which is kind of scary. Uh, when they get tired of ponying up the money for insurance and they're no longer carrying those hedges, if they were to get caught off sides, the extreme speed that we would move to the downside is going to be well, that's going to be scary. That would tie in directly with watch for a correlated market state. Keep your eye on the AD. So you don't want to see us get above a 90. That's when a market can really make extreme moves. So right now, just continue to watch that dollar as a gauge on global risk. When we see the dollar fading off, it is a sign that the global market is moving their capital into the marketplace. Stocks, bonds, they're moving it somewhere other than the dollar. Right now, the dollar is their safe haven. The dollar is their safety net. If they can't go to cash without taking a punishment, without paying fees, significant fees, then they'd much rather park their money somewhere. Well, where are they going to go? Bonds are getting beat down. Stocks are getting beat down. There's really nowhere else to go except to put it into a financial asset like the dollar. They're not going to put it in the ruble. They're not going to go to the peso. Our junk is better than anybody else's junk right now, because they're going to the dollar. So when you see that dollar going down, it implies they're willing to put that money to work somewhere. We got to then take a look around and ask, where are they going? Where's that capital rotation focusing next? Right. And we've seen it lately. They'll pick a sector and just hammer that thing, like retail or healthcare. Just everybody piling in to that one single sector. Talk a little bit about what happened yesterday. Um, when you talk about a safety net or looking for a place to go, there was nowhere to go yesterday. This is the 9 grid we use to look at the sectors. 3 on the bottom are your risk off sectors, 3 on the top are your risk on sectors, and the 3 in the middle are the midline. This is a daily chart perspective of those 9 sectors. And every single candle on here is either a doji or it was red, except for utilities. But even that one, it gapped down and then rallied back up into its previous day's price action. And that was the only one that even had anything. So out of all the sectors yesterday, there really wasn't anywhere to go. If you go back and look at COVID, when we started to dump down in February, there was no safe asset. It didn't matter if you were in utilities or gold, or it didn't matter. The only thing that didn't go down was the VIX. Everything went down. People were continue to ask me questions about gold being a safe asset or a hedge against a downside move. It's not. The banks sold the gold back in February when COVID was hitting, because banks were getting margin called and they needed to raise capital. They raised capital the only way they could. They sold their gold, which made the gold go down. So there is no safe place. When we keep talking about gold being the hedge right now, or the hedge trade, right, is the phrase that we've been using, that's really tying more into this current asset allocation and where are they putting their money, right? And they're hedging against the inflation rise, not hedging against a downside move. Another thing about seasonality or uh, historical perspective of what's been happening in the world before, when they raise rates, the market rises, right? So I mean, when we try to price in what they're going to do, we see the market falling. They're pricing it in. But when they actually do begin raising rates, go back and look at what happened in the marketplace. Every time they do that, the market goes up. So it's not a bad thing. It's a good thing. Right? I think it's a good thing because I want to trade to the upside. I don't really care though. If we're going to go down, let's make money going down. So there was no place to hide yesterday. It's always important to try to take a look around and not just narrow in on one sector and say, oh, this sector's going down. We have PPI today at 8:30. This is very likely going to be the drama of the day. Energy's continuing that rally to the upside. If you look at 52-week highs, things that are continuing to do good in the current market conditions, in the current market environment, it's energy, consumer staples, and healthcare. So, Halliburton, Devon Energy, Hess Corporation, Marathon Oil, I think is starting to get the hint, right? But it's not just those either. I mean, Hershey's is still doing really good. There's some retail names that are doing good too. So when it comes to finding opportunities in the current market environment, there's plenty. They're just not the sexy go-to tech names that we've been talking about for the last 5 years. Can be on the alert for a 1 p.m. reversal today. We have an additional auction at 1 o'clock. It's one of my go-to things that everybody tends to ignore. An additional auction at 1 o'clock. It's a really big deal. If we've been range bound all day, when we get to 1, we could begin the trend. If we've been trending all morning, this could absolutely kill it. So keep your eye on the 30-year bond auction at 1 o'clock. And then it's not just the fact that there's going to be an auction there. Look at the bond afterwards. Heck, look at the bond in the 10 minutes before the report. See if they start jumping the gun and going in there early and moving that thing around. It's /ZB. All right, we take a look at the sectors this morning. Jets, cloud computing, natural gas and energy, Bitcoin, chips, the devil's metal, silver, emerging markets, which is our gauge for global risk, technology, small caps, and then we start getting into things that are more flat on the morning. If you look at the FANG names, not just the FANG names, but it's a good place to start. If you look at the FANG names on their daily chart, Facebook, Apple, Nvidia, Google, Tesla, Netflix, Amazon, Microsoft, they all had a red day yesterday, and in the pre-market we are rallying. This is a red to green setup, right? Red day yesterday, closed in the lower portion of the red day. In the middle of the night or in the overnight hours, we start to get that rally to the upside. We want to see this open near the open of yesterday and then rally outside of yesterday's candle. That's an R2G trade setup, red to green trade setup. If you can tie it into something not just red to green, but perhaps an IX10 or an inside day breakout, then you're combining two different daily chart signals for a trade opportunity. Recognize, by the way, if you're doing OCR analysis, that Facebook and Nvidia had an outside candle. Whereas, like Tesla did not, right? Even Amazon. And if we're looking for compression plays, like an inside day breakout, I would much rather focus on Tesla or Amazon. only because they have the smallest candles in the pattern. Right now, if we're talking dollar wise, that wouldn't make sense, but we're talking percentages, right? That's how we can compare apples to apples instead of bananas and walnuts. The smaller the move, the smaller the candle, the smaller the compression, the better the breakout. So when it's a really big, really wide candle like Facebook or Google, doesn't really get me excited about an opportunity to trade, right? That doesn't tickle me. I want a really tight, really compressed market like Tesla and Amazon. So these two inside day breakout IX10 R2G setups are going to be the ones that I'm watching this morning. You can take the day trade. The day trade would be at least a 4% move. Or you can take the swing trade and aim for the last swing. In Amazon, that'd be 33.65. In Tesla, it'd be basically 11.20. Right around in there. I've done videos on these trade setups. They're on the Bullish Bears in the Next Level library under strategies. So if we do get that breakout, it's going to also be presenting a trend line breakover, TRB. So if you see me talking in the chat and I say TRB in chat, it's trend line breakover. There's a video on that as well, trend line breakover. It's not like we're specifically actually drawing a trend line and saying, oh, it broke the trend line. You can, there's nothing wrong with that, but don't get hung up on how it's drawn or where it's drawn. Use your eyeballs more than your drawing tools, and just recognize that there is an angled resistance. And if we happen to have an inside day breakout on Tesla, for an example, and we get above to yesterday's highest point, then we also did have a TRB. Right? But if we take something like Netflix and I try to use my drawing tool, well, it doesn't quite line up right. Right. And then it's like, well, where do I put it? On the wicks, on the body? Don't get hung up on the nuance of this. We had a consistent, persistent move to the downside in Netflix. If we now get a red to green inside day breakout with an IX10 setup, it's also going to be a trend line breakover. Right? Because the trend was to the downside. We've now broke that downward trend and we've crossed above the lowest, how do they say it? It's a Cahold candle at highs of lowest day. Yeah, there you go. Cahold. And if you want to know more about Cahold, Thinkorswim talks about it a lot in their webinars. So you can learn about Cahold. So that's just one more setup, right? IX10, R2G, inside day breakout, Cahold with a TRB. And if you're confused and you don't know what the hell I'm talking about, write those things down and begin going through them just one at a time, right? You don't have to learn it all at once. Just have to consistently move in the right direction. All right, so not Thinkorswim, the S&P doesn't have um, a modern perspective when it comes to sectors. We have to kind of make our own. There's a few sectors that they just don't cover well. The S&P has those legacy 11 sectors, but it misses things like the electric vehicles market. Looking at the electric vehicles market this morning, you can see that most of the names on our list are doing good, and the ones that are not doing good, they're more directly connected to different aspects in the EV market, whether it's autonomous driving or battery development or some other part of the supply. The names that are doing good this morning actually produce vehicles in some form, like GM, Ford, NIO, Li Auto, Ride. These are all names that are doing good this morning on the EV side. So let's take a look at what else we got out there. We know that the chips are doing good this morning. How good? All of them. Every single name in the chip name list is doing good this morning. That's how good chips are doing. Waterley, huh? Yeah, you like it. What else we got? Come on. Pot stocks. You know, it's a mixed bag. Got some stems in there. Clean it out a little bit. When it comes to the pot stocks, it's often beneficial to break these down into recreational versus medicinal or breaking it yet again down another sector to um, oils and edibles and things like that. Even a name on this list is connected to real estate because there's a pot stock real estate company, 22nd century. So, when it comes to any of the sectors, subsectors, and sub industries, taking it one step farther can really help when you're trying to figure out why are some names up and some names are down in the same sector. Finance is going to be really important today when it comes to making that distinction. What kind of finance? Since the banks kicked off this morning, and a couple of them are already showing us that there's a lot of pain on the horizon. All right, so what else we got? We did crypto. Can't leave out crypto. There are a few names that are down this morning in the crypto space or sphere. Keep in mind, like I continue to say, this is not a list of crypto names. This is a list of companies that are heavily vested within the blockchain and or own a lot of crypto. But we can see that those names are also doing really good this morning, and there are a few that are slightly down or flat. They're worth keeping your eye on, especially if we're going to get a rally up off of those, something like PayPal. We had a red to green setup in PayPal, and well, we're not getting the green yet, but we definitely had the red. We're also on the edge of the Keltner. Yeah. Yeah. Yesterday, we had to be very astute to be able to find opportunities. The sectors were not going to provide us with anything. Today is not going to be like that. You should easily be able to lean into the sectors for your opportunities to trade. Follow the sectors down the rabbit hole. The weighted names that make up that sector will provide the greatest opportunity. Again, be very, very cautious of a highly correlated market state. It is when the market can make some of the most extreme moves we've ever seen in market history. That's what I got for you guys. Be careful, be safe. Have a good morning. I will be streaming in the large caps starting at 9:15. I'll see y'all there.